G'day, ladies and gentlemen. My name is Craig Cobb. I'm a trader of 20 years, and if you want to make your trading better, hit subscribe. Now, into the next video that I'm looking at here within this trading education series, and it's really around profit taking. Yep, you got to find the trades. Yep, you got to stick to your rules. Yep, you got to manage your risk. And then the final stage is to turn that risk into, obviously, profitable rewards. And there is a systematic way of doing this as well. And it is one area in your trading that will probably move and shift like the tides as you get more data on your own self. Now, we're going to have a look at win-loss ratios here because I see so often too much emphasis being put on, a win-loss ratio and not enough on a reward-to-risk ratio. So those two, a win-loss ratio needs to be coupled with a reward-to-risk ratio to have any real merit and to be able to give you any real understanding of what an edge looks like. So we're going to touch on that. Now, the reason I say that this might change for you is one of the things that I teach in my full course and in my Discord group is to take screenshots of your trades. Now, it's not fun to do that. It's not sexy to do that. Neither is doing the accounts in your business. You know, there's a lot of things that aren't particularly sexy about running a successful business. And this is one of the not sexy parts of running a trading business, is capturing the moment when you took the trade or when you decided you were going to take the trade. Now, when you've got that data collected from your, the timeframes that were important in your entries and what you were planning on doing to the outcome of the trade, what you're able to do after you get, say, a sample size of 10, 20 trades, the more the better, obviously, is you're able to actually go through and play out some scenarios around reward to risk ratios to see what you would have been better off doing. Now, you've only got that as hindsight, but we can use that hindsight to have a look at what you might do in the future. So you might start taking 2-to-1 profits, and you might actually do over 10 trades, look at things and go, I'm better off taking 4-to-1, really. And if that is the case and it fits your mindset, great, you will adjust to that 4-to-1 target. But I'm going to go through it right now. It'll make more sense to know that it can change for you. So keep that data, keep trading, keep your discipline, and then work to have, squeeze as much juice out of the lemon as possible. So the two variables, reward risk ratio and win-loss ratio. Now, the success rate, like a reward to risk, a win-loss ratio doesn't really mean a great deal, as I say, unless you combine it with the reward to risk. Now, I could have, I remember I had an automated trading bot that I would run on the TF, which is the mini Russell 2000 contract in the US for futures. This was going back a long time ago. It was automated because it would raise the order itself. I would still have to monitor it, but I would lose about 70% of the time. But on the 30% of winners that I would get, I would end up profitable over the period of, a number of trades. And it was a trade that would happen 5 days a week, more or less. It was an on the open. And the problem that I had, I stopped doing it. You think, hang on, Craig, you said it was profitable. Why would you stop doing it? Well, because I'm a discretionary trader as well. And my money's made discretionary trading, which is what this series is to show you some of the tools that I use. The issue that I had was, if I come off the back of, say 3 losses in a row on the TF automated strategy, when it came to my decision-making process in the discretionary market, I would feel like I'd carry that loss into my discretionary trading. Now, they were totally separate, right? But it would stop me from executing on some trades in my discretionary trading account, and that was where I made more money. So what I had to do was realize that it didn't suit my psychology, where my bread and butter was through me making my own decisions on my trades based on what I'm teaching you. It wasn't based on an automated strategy. So I had to cut it. I had to cut that profit out so that I could function and profit better with my discretionary trading. So the win-loss ratio is important, coupled with a reward to risk ratio, but also you got to understand what you're going to be able to get through. If you're going to lose 9 times out of 10, but the 10th is a profit, it's quite a bit to deal with going through those 9 losing trades. So let's have a look first of all at 1-to-1 reward to risk ratio. That means if I risk $1,000 on a position, I'm looking to take $1,000 only. And this is just pure, simple math, okay? So if I've got a win-loss ratio of 50-50, so half the time I'm correct and half the time I'm getting stopped out, half time profit, half time loss, then I end up with 0 at a 1-to-1 reward risk ratio. There's no edge there because I'm 50% of the time right, 50% of the time wrong, and I'm leveling everything out on break even at that. If I then increase my win-loss ratio through experience, knowledge, and being able to trade well, I go to 60-40. Well, now I'm up a multiple of 2 on my risk. So if there was $1,000 risk per trade at a 60-40 win-loss ratio with a reward risk ratio of 1-to-1, I'm going to be net positive on 2% or $2,000 with a risk of $1,000 per trade, and so on and so forth as you work down through these numbers. Now, with 1-to-1, Targets, I'm probably more personally between 65 and 70%. So I can make it work. And to be fair, when I traded every other market, stocks, bonds, commodities, a lot of my trading was actually, in fact, taken at 1-to-1. That was my most prolific target, and I was very good at getting it. I could make a living off of 1-to-1. But what I want to show you is a couple of things that can change. Because and please take this for what it is. This is just the simple math of it. It's up to you to get the returns, to get the results. And you're not always going to have it turn out exactly like it does, boof, 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 in this sort of spreadsheet environment. If you go to a 2-to-1 reward to risk ratio, you've got to understand you're probably not going to get as many trades that are going to hit that target. But that's okay if you're getting it enough. So if I'm looking to double my rewards, if I'm risking $1,000 and every single trade that I hit my profit, I'm going to get $2,000 back. Well, naturally, I don't need to have as many trades go in my favor. So if I can be sitting at a 50-50, so we'll start at that 50-50 number that we had with the 1-to-1, which was break even. If I can get half the trades hitting my stop loss and half of the trades hitting my profit, I'm going to end up for a multiple of 5. This is over 10 trades. Okay, so I will have a multiple of plus 5, which would be $5,000 in profit if I'm risking $1,000 per trade. Now work those numbers down to whatever suits you. I'm just doing round numbers for the simple math purposes. If I get that to 60-40 on plus 8, 70-30 plus 11, 80-20 plus 14. But you have to understand, as your reward multiple increases, so too will your stop out margins, more than likely, because it's double the amount of 1-to-1. So you've got to be aware of how this works. And as I say, this might shift with you. Now we move to the 3-to-1 reward to risk. It doesn't take a great deal. I can get 70% of my trades go against me. And this was what the Russell contract that I was talking about was. 70% would go against me, yet I'm still up to a multiple of 2 on my risk. So if I'm risking $1,000 a trade, I get 70% of the trades wrong. Over 10 trades, I'm still making $2,000 as the sheer simple math goes. If I can be sitting at a 50-50, half my trades get stopped out, half my trades hit their 3-to-1 target, I'm sitting at a whopping 10x multiple of risk, and so on and so forth. So as your reward increases, as your target reward increases, and there are videos, by the way, in this series of how to go long, how to go short, and how to put the order in with a predefined exit point, a take profit as well. So you've got your stop loss managed for your risk. You've got your profit managed in your reward, all in a single order. So go watch that video. You can really do some big numbers if you can get 3-to-1 at 50-50. But again, this is not just to tell you, oh, well, obviously we want to be aiming for the biggest possible target. No. I wanted you to understand how these numbers work. I want you to monitor your trades, and I want you to see what's going to work for you. Now, in certain periods of the market, when we go through expansion and contraction, you're going to find that the 3-to-1 targets or 4-to-1 targets or 5-to-1 targets work really, really well. And this is down to the rule of that 80% of your profits will come from 20% of your trades. When we've got really strong trends, be it up or down, really good cyclical markets, that's when the bigger profit margins come to you. At the moment, in the current present day for which I am recording this video, which may be irrelevant when it comes to you watching this, I'm looking for 1-to-1. Why? Because the market is incredibly choppy. So it's about knowing the ballpark of what you have to work with and being able to flow between each of those different states. The real key is knowing when to pull it back and when to extend it out. Okay, really, really important that you can do that. And that just comes with experience and time. So as I said, it might look like, 3-to-1 is the one we should always go with. Well, it might not be the case. Okay, you've got to keep in mind that it's up to you. You need to monitor your trading and see what works for you. I'd love to have big profits on every single one of my trades, but when the market conditions don't allow it, all I'm going to do is be dreaming of big profits while slowly chipping away my account, risking 1% per trade. It's not good for my mindset. It's not good for my account. You need to be able to understand the conditions for which you're trading within, and you need to work within those conditions, and you need to maximize your returns while minimizing any damage that can be done to your psychology and your psychological state, because a calm mind makes good decisions. I hope you've enjoyed this. Don't forget, sign up to the link below. BloFin is the exchange. They've sponsored this event, and I hope you enjoy it. And watch the rest of the series. Have a ripper day. Bye for now.